Welcome back to The Explainer. Today is June 9th, 2026, and looking at the crypto markets right now, it honestly feels like we're watching the climax of a high-action anime. The market is violently split right down the middle, a high-stakes showdown between widespread retail panic and calculated, aggressive institutional strategy. Let's get into it.
Okay, let's dive into this. 9. You heard that right, a single digit. As of today, the Fear and Greed Index has plummeted all the way down to a 9 out of 100. We are talking about extreme fear, representing the absolute lowest and most pessimistic sentiment we've seen in the last 30 days. Retail traders are terrified.
So it begs the ultimate question, right? With the market absolutely terrified and retail running for the hills, why on earth is smart money aggressively buying the dip? It's a wild contradiction. When the crowd is screaming sell, the titans of the industry are quietly and massively stacking their bags.
Section 1. A violent market split. Retail panic versus institutional accumulation. We're not just talking about a little market friction here. This is a fundamental divergence happening right at that crucial $60,000 Bitcoin support level. On one side, retail is in full-blown panic mode, getting flushed out by liquidations and macro pressures. But on the flip side, massive institutional entities are just casually scooping up assets, basically building a titanium liquidity floor. And the big takeaway for us is that this intense tug-of-war is anchoring the market right around $60,000 for BTC and about $1,650 for ETH.
Section 2. Whales buy the fear, accumulating at the lows.
Let's zoom in on the heavy hitters, because for true market whales, blood in the water just means a massive discount. $101.3 million. That's the eye-watering amount. Strategy, the company formerly known as MicroStrategy, just dropped to snag 1,550 Bitcoin. They raised stock, turned around, and fired that capital straight into the teeth of this panic. They aren't flinching one bit.
And this brilliantly illustrates that this isn't just a Bitcoin-only narrative. While Strategy was busy buying Bitcoin, BitMine stepped up and made its biggest Ethereum purchase of 2026. We're talking nearly 127,000 ETH, valued at roughly $214 million. The smart money is moving in these heavy, synchronized strikes across both major assets.
Now, if we look under the hood at the derivatives market, things get really fascinating. Bitcoin open interest has dumped 26.8% over the last month. Now, hearing that might sound scary, right? But actually, it's a deeply healthy systematic deleveraging. It's like a hard reset, washing out the weak hands and over-leveraged traders to build a much more solid foundation for the next move.
Section 3. The ETF tug-of-war. Diverging capital flows.
This violent split we've been tracking, it's playing out directly on the ETF battlefield too. On June 8th, Bitcoin spot ETFs took a hit, seeing net outflows of $91.37 million. But over in the Ethereum camp, the ETFs actually flipped green, pulling in $82 million in net inflows. So bears are actively dumping Bitcoin ETFs while institutional capital is rotating heavily into Ethereum ETFs. It shows a very clear preference for ETH right at this specific moment.
But wait, we need to add a little nuance to those Bitcoin outflows. Yes, BlackRock's IBIT saw a massive $233 million exit, but that was actually offset quite a bit by ARK Invest grabbing over $63 million and Fidelity pulling in over $59 million. So capital isn't entirely fleeing the Bitcoin space. A lot of it is just rotating internally between the different funds.
Section 4. Hacks and protocol panic, the dark side of decentralization.
Now, we've got to shift our focus to the darker trenches of the market, where things are honestly pretty brutal today. Negative 82.85%. That is the sheer cliff-drop collapse of the Humanity token, or HU. While the major assets are holding their ground, this token just experienced a catastrophic full-scale repricing.
So what went wrong? Well, the Humanity Foundation had their private keys compromised. Attackers swept in, drained over $32 million from 17 different wallets, and then immediately dumped those stolen tokens right onto the open market. The project is scrambling, running everyone to avoid their bridges and liquidity pools. And the kicker? This happened just weeks before scheduled token unlock. On-chain sleuths are already flagging suspicious pre-hack pumps. It's a harsh reminder of the very real security risks still lurking out there.
Section 5. Speculative altcoin surges, the trenches of high risk.
But hey, even with extreme fear and protocol hacks dominating the headlines, the appetite for risk? Yeah, it's far from dead. Actually, it's wild right now. 5,500%. That is the mind-boggling explosion we just saw from a high-risk microcap token called Jotua. While Bitcoin is barely moving a millimeter, retail traders in the trenches are out there hunting for pure, unadulterated volatility.
We're also seeing two totally different realities driving some altcoin pumps. On one side, FTT surged roughly 30% purely on reports that Sam Bankman-Fried formally filed for a presidential pardon, literally just legal speculation driving the price, with no fundamentals behind it. Contrast that with Zcash, which had a solid 6.8% relief rally, fundamentally driven by its developers patching a critical, hidden vulnerability from 2022. Two completely different kinds of surges. Section 6. Regulation and Macro Horizons. The rules of engagement.
To truly grasp what's happening today, we have to zoom out and look at the macro chessboard. Over the weekend, on June 8th, over 200 crypto firms banded together to push the Senate on the Clarity Act for developer protections. Today, June 9th, the SEC dropped its new draft strategic plan. And looking ahead to next week's meeting, a Reuters poll shows the Fed is widely expected to hold interest rates steady, between 3.50% and 3.75%. Basically, sticky inflation is keeping the Fed cautious while the crypto industry is mounting its most coordinated legislative push ever.
Let's talk about the SEC's new playbook. Chairman Paul S. Adkins went on record saying, "During my tenure as chairman, the commission will not stray from this core three-part mission." This sets a very distinct, back-to-basics tone for the agency going forward.
The draft outlines three primary goals. Goal 1 focuses on supporting innovation and capital formation. Goal 2 aims to increase stakeholder engagement and return enforcement to its original intent, meaning policing actual violations like fraud rather than just regulating by lawsuit. And Goal 3 is all about optimizing operational efficiency using modern tech like AI and blockchain. It's a fascinating pivot toward modernizing their infrastructure.
So, what's the bottom line here? The data heavily suggest we are in a bottom-building process completely anchored by institutional buys. But, and this is a big but, to confirm a genuine recovery, Bitcoin has to break out of this consolidation phase and reclaim the $68,000 level. Until it does, we are just sitting in a stabilization zone.
Which leaves us with this final, burning question. With retail completely panicked, leverage washed out, and titans like Strategy and BitMine aggressively loading their bags, is today's extreme fear just the quiet battlefield before the next massive institutional breakout? The board is set, the pieces are moving, and we will be right here to explain the next big strike. See you next time.